Know the difference with Annex Wealth Management and the Annex Wealth Management Year in Review. We're going to look into 2022 with Derek Felske, our Chief Investment Officer at Annex Wealth Management, and Dave Spano, President and CEO. Dave, would you like to go first?
Sure, of course. You know, we talk about what could 2022 look like, and we don't really want to guess, but what we do know, what are the facts that are in front of us, is that the Fed has pivoted. They are going to change course, and that means it's more of a tightening to some extent than what they have been doing. And when that happens, there will be a change in interest rates. Change in interest rates means a change in how securities are priced. So to me, I think that's where you have to start. What is the Fed going to do in 2022? They're talking about finishing the taper up and perhaps raising rates. Question is, will they do that in front of an election?
Well, I think they will. It's going to be a data-dependent situation. Right now, the market is expecting 3 rate hikes next year. In my view, the economy can probably handle that. But what will happen with the stock market is higher rates tend to depress multiples. Yep. So that can affect the valuation of companies. So even though companies might report great earnings, the valuation a quarter of those earnings may be lessened. And that's typically what you see when you see inflation north of 3-4%, yep, and also a tightening Fed. So I think you have to expect more muted returns next year. I think you'll expect to see more volatility because, again, the Fed has dampened volatility in the bond market, which then spread into the equity markets. You take the Fed away, you eliminate stock buybacks to some degree because there's less liquidity around. You're just going to see a more volatile market. My expectation is the market will go up next year because it does 80% of the time, but that's the extent of my crystal ball on that.
So, but let me just add to this. So low rates mean that people move from treasuries to more corporates, right? More sensitive to interest rates. People move from bonds to stocks, and people move from defensive names to more speculative names. That could reverse as interest rates go up. So that means your asset allocation and your portfolio would look differently. And by the way, what you mean when you say multiples contract, what that means is right now we're trading at 22, 23 times earnings. If it goes back down to 18 times earnings, which is at least in the neighborhood of a more normal number, that means that the S&P 500 is going to have a little tougher time moving forward.
Right, and we're also going to be in a midterm election. Historically, on average, you've seen a 15% drawdown in stocks during midterm years. The second year of a presidential term typically is the weakest year of the 4 on the presidential cycle.
And let me just jump in there because it's really important, and people hear that right now, and maybe their blood pressure goes up. Remember, this is a snapshot. It could go down 15%. That is not a permanent situation. Almost always it bounces back.
Right, and that's 15% is a drawdown, not necessarily an absolute decline of 15%, which would put us well within correction territory. But it really does suggest to me that if you're looking at your portfolio now into year end, take a look at your 401k balances, because my guess is if you've invested in equities at all, you probably own more stocks than you did when you initially invested. It's well above your target. And that's why we talk about rebalancing, but rebalancing proactively, not just because it's the end of the year in this case, but because assets have been stretched in opposite directions, and there are opportunities that can be availed by reducing risk through rebalancing.
So a couple of things that are in front of us, there clearly could be an incident risk, something that you cannot prepare for. We know that Russia's at the doorstep of Ukraine. We know that China is looking at Taiwan. All of those are incident risks. You cannot plan for them. But as Derek just pointed out, you can adjust your portfolio to take an impact.
7 years ago, I think I started working with you guys doing the radio shows. And Dave, every once in a while you would mention, listen, we could have a global pandemic. Mm-hmm. And look at this, years later.
I wish I wouldn't have said that.
And really from January 1st through the end of the year, that was the dominant story.
All of 2020 and 21 and perhaps into 2022. Hopefully this last go around is the one that really knocks it from a pandemic to an endemic, and we put this in our rearview mirror.
Might there be any surprise sectors that pop next year?
Yeah, I was actually thinking about that the other day, because you remember at the end of last year, the energy sector was left for dead, right? ESG investing, everyone was against global warming and this and that. And the energy sector is actually the best performing sector this year. A sector that's really performed poorly this year, for any number of reasons, is the biotech sector within healthcare. And I'm not talking about all those small companies in the Russell 2000 that may or may not exist a year from now. I'm talking about, big names in the biotech area. And those stocks are extremely cheap. And let's face it, I think our healthcare system proved we can be innovative with the rapid rollout of these vaccines. So the biotechs might be an interesting play in 2022.
Derek Felske, Chief Investment Officer, Annex Wealth Management. Thanks for your insight in 2021, and we will see you in 2022.
My pleasure. Happy New Year to everyone.
And Dave, thanks for guiding us through 2021. I think 2022 is going to be an interesting year.
It certainly is going to be interesting, and thank all of our listeners for the opportunity to share our thoughts with them.